of reports. Sorry, I gotta push my button. Okay, well, good morning, everyone. Another gloomy day, but the sun is on the way, I hear, so hold on for a couple more days. We have a pretty full agenda today. And following our discussion from the last board meeting, we're going to try a little different way of doing our votes. I'm going to call for a verbal vote, ask for those in favor, those opposed, and those abstaining. And if any are opposed or abstaining, then we'll defer to a roll call vote. But if everyone's in favor, we can just move on. And if any member wants to call for a roll call vote for any reason on any item, please let us know. But we will need to do a roll call for attendance. Let's start with that.
Good. Jerry Abrahams.
Here.
Phil DeFronzo.
Here.
Timothy Hodges.
Here.
Kathy McKinnon.
Here.
Commissioner Perez. Franklin Perry.
Here.
Chelsea Ross.
Here.
Sarah Sanders.
Here.
You do have a quorum in attendance.
Okay.
Madam Chair, could I just ask that if any of the board members leave the meeting to let us know, just so we'll have an accurate record of the voting?
Thank you. And I will try to remember to ask if anyone has joined that wasn't on the roll call when we take a vote, so that we know if someone who came in. Okay, so our first item is resolution for the next bond sale. Over to Hazim.
Good morning, everybody. The resolution before the board this morning is to authorize CHFA to issue up to 175 million of the housing mortgage finance program bonds. The sale will allow CHFA to raise additional lending proceeds for about 715 first-time home buyer. As of January 19, CHFA had an aggregate net pipeline of about 286 million. CHFA will utilize a fixed rate structure and expect to close around March. BFA Securities has been assigned to act as the book running manager for the bonds, and I'll be happy to answer any questions regarding the resolution.
Hey, Hazim.
Yes, Jerry.
It's Jerry. Hi, good morning. How are you?
Good.
What are we doing? So BFA is going to be booked. I assume City's out of the syndicate now?
Yes. So for this, yeah. So you were asking
Can
for
you repeat the question, please?
I couldn't hear.
Yeah.
Sorry, I'm like having communication issues this morning. Yeah. So basically, Citibank, which was one of our book running managers in our vacation, and they're exiting business. And I was just wondering, Hazim, we're going to do something off cycle. Are we going to elevate someone from the co-manager group? Just Hazim, if you could just let the board know what the plan is with their exit.
I couldn't hear that. Can you repeat that, Hazim, as you understand the question?
Yeah. So Jerry, I'm just going to paraphrase what I believe you were asking. So number one is about Citi, because Citi is part of the senior managing rotation. So last year we were informed by Citi that they are exiting the finance underwriting business effective today. So for this particular resolution, we have excluded them going forward from the syndicate. Additionally, we also were informed by UBS, who effectively said the same thing, that they are no longer providing any underwriting business for municipal finance. So they also have been removed from the syndicate, and it's not part of the resolution. And I think the follow-up was then what happened. So we, as you know, we have a diversified, broad firms. They are well capable to fill the role of Citi along with UBS.
Is there anything else? Anything else on this sale that's different than your standard, other than the change in underwriters?
In terms of the current market condition, we are utilizing the same structure that we did back in 2023. So unless something happens to the interest rate curve, we will stick to the fixed rate structure.
And what is, Hasim, what is the interest rate on this? Or like, what is the expected interest rate on this?
In terms of the overall bond yield,
Yes.
so right now it's fluctuating between 4.2 to 4.3.
And that's at a par price.
That includes some premium. Yes.
So what would,
Yeah.
do you know what that premium would be?
The premium probably is going to add another like 15 basis points, plus or minus.
Okay. And then what's the cost, what would be the add-on for the cost associated with that to issue the bond?
Well, when we sell the bonds, we generally will spend upfront like around 1 point.
For cost.
Yeah, for cost.
So my question, if it's 15 basis points added to the yield and then 100 basis points added to the cost, have we explored the option of like, looking at selling loans on, directly to Ginnie? Is there a benefit to having this tax-free bond that I'm not aware of? Like, have we explored the yield difference between doing it at a par pricing at Ginnie, or do we do a best execution every month to see like, well, it's better to do, because I'm understanding like, you can do a 5% bond at Ginnie right now to par. So if this.
Right. So the answer to your question is we do look at best execution. And I think the question is whether or not you can, number one, get the execution that you mentioned to get a par price at 5. So assuming that you can get par at 5, you still also have to take into consideration the cost associated to delivering the loans. So the point that I mentioned about the 1 point is only associated to the cost to issue the bonds. We still also have to pay for lenders fee, and as you know, Phil, that we pay 2.5 points for that.
No, but I mean, we're just comparing bond to bond execution. We're not comparing about what your costs for the lender, because if you already have a loan that you're selling it, you're paying for a lender fee regardless. So I'm just saying, like, if I had $50 million of FHA business that I could sell to Ginnie, can you share with the board next meeting what the comparison would be of doing this bond versus doing a portion of this bond in a Ginnie execution? Because $100 million at 50 basis points is a lot of money.
Right, absolutely. But I think what I'm trying to get at is when we sell bonds, the asset remains on our books. So we are basically amortizing the cost associated to the the underlying loans that we made. If we start selling it outright, you still have to pony out of pocket. So you can't sell it at par at 5. You have to go something even higher, of which you then need to charge the borrowers that we're trying to help a higher rate that we're currently offering. So the whole theory about selling debt is basically you're amortizing and you're trying to make the revenue over time and repay you back because you already, quote unquote, have non-asset position the moment when you sell the bonds. So that's the reason why that.
Could you illustrate that to me in numbers in comparison to what you would sell on a FHA? Could you show me in numbers comparatively, like how that would look?
Yeah, absolutely.
Okay. All right, then I'm good. Go ahead.
For a future board meeting, and because I didn't quite follow all that. I think that'll be helpful.
Yeah.
Yeah.
This is very timely though, because this is something we're interested in looking at. One thing I want to point out is that a lot of state housing finance agencies are actually moving back to issuing tax exempt because the advantage of tax exemption right now is the greatest. It's been in a number of years since the Fed, was holding down rates and all of that eased off, and now we're seeing the value again. Not to contradict what you're saying, Phil, but just
No, I just want to see
Yeah.
it in numbers. I don't.
Yeah,
I could be 100%
absolutely.
wrong. I just,
So I think, we're absolutely happy to do that. I think there are states that are now moving back to the bond business because they couldn't get the sale business to continue to work for them and provide the competitiveness on the rate side as far as, or even make it work on the rate side. So, but yeah, Hazim I'm sure can take it up and we can come back with some analysis.
that's good. Okay.
Is the comparison you're going to do also kind of related to the comparison of doing tax exempt bonds versus a TBA program where you're just selling off the?
Yeah, that's essentially what it is. It's just trying to compare whether or not it's better to make or receive an annuity stream over the life of the loan versus an upfront income that is only one time.
Yes,
But that's
that's a
essentially
big difference, I know. Okay, so for a future meeting, because I know we had talked about maybe putting in a TBA program, so.
yes. that is-
Okay. Has any board member joined since we took the roll call that we want to recognize? With that, I think we're ready to, I'd like to ask for a motion to approve this resolution.
Move it, Kathy.
Second,
Second. And I think George joined us since.
That's correct, but when they took the attendance, I was going to acknowledge it.
okay, great. Thank you, Commissioner, for joining. So
Yep.
we're going to do a verbal vote. We're going to try this. So all in favor, verbally vote in favor.
Aye.
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 Are there any opposed votes? Are there any abstentions? Hearing none, the motion passes. Next item is the resolution regarding the funding of the Opportunity Fund. Hazim.
Thank you. So back in 2020, the authority created the Opportunity Fund to act as an additional source of funding for affordable housing by transferring 50% of the net interest margin from its master trust annually. Since 2021, the authority has deployed over 20 million for special programs, rate buy downs, and subordinate loans. Last November, the authority solicited feedback from members regarding the funding ratio for the Opportunity Fund. Based on the authority's analysis and to meet the needs of the 2024 strategic plan, the authority is recommending a one-time transfer from the IDA to the Opportunity Fund totaling $5,546,499, and to increase the funding ratio to the Opportunity Fund from 50% to 75% of the net interest margin. I'll be happy to answer any question regarding the resolution.
I had enough. I missed her question today. So the Opportunity Fund basically takes the interest margin that you get from all programs or from single family residential?
No, all programs. So
All
it's
programs.
under the master trust. Yeah.
Now, I guess my question would be, is there, once again, it's like being a numbers guy, it seems to me like if you have that much of an interest margin and where our mission is to provide low cost, what's the trade-off between lowering our interest rates and giving this to more people than using this in the Opportunity Fund? I guess it feels like I'm robbing Peter to pay Paul.
You are asking the right question. So in theory, mathematically, it's the same. So effectively, when you have a pool of assets, whether or not it's multifamily, single family, after you pay off any obligation related to financing the pool of assets, then you will have, or what's left would be your net interest margin after you pay off all your obligation.
Right.
If you adjust the interest rate for that pool of assets lower, then the net result would be you will have less net interest margin. And if you have a higher interest rate, then of course your net interest margin will also have a corresponding or an inverse effect. So that's one way. But the other thing that it also comes into play is the fact that when we sell bonds, we also from time to time will redeem or refund the bonds. Therefore, we would reduce the interest expense associated to the original financing. So over time, we would generate additional net interest, net margin, because of what we did over the life of the loan and the bonds. So
Okay.
it's not just, so you can say, we can start off a financing for a particular pool of asset and we only make 50 basis points. And that 50 is only to cover our overhead. That doesn't mean that that 50 will remain, because we have the opportunity to reduce the interest expense associated to that pool. Therefore, the 50 actually would go up.
Okay. All right.
I have a couple basic questions. So these two tweaks that you're recommending, those are required to get to the 22.2 million, right?
Yes.
Okay,
Yeah.
I assume that. And then you attach the policy from 2021.
Right.
And so making these tweaks is provided for under the policy, and we don't need to change the policy.
Correct.
Okay.
The policy is more to refresh everyone's memory in terms of what was the purpose, what was the intent. So that was the reason why we included the policy.
Okay.
Any more questions before we start the voting process?
Is there any downside to doing this, Azim, going from 50 to 75?
No, because the way I think it's more about reclassification, if anything, because when we need to spend monies in the ITA or in the opportunity fund, we would present a resolution to the board. But the moment when we put it into the opportunity fund, we are effectively telegraphing that the need and the use for the opportunity fund would be based on the policy. But in terms of the overall for the mission, whether it's ITA or the opportunity fund, it's just two separate accounts.
Thank you.
And the going to the 75%, that's just for 1 year, or is that the way it reads? It looks like it could be an annual going forward.
Yeah, we're going to do it going forward. So,
Okay.
Yes.
So that's a relatively big change.
So in 2020, we did a strategic capital analysis, right? And we looked at our funds and our resources, the ratings, and the recommendation was made for 50%. So since then, as Azim said, we've deployed the funds. There's been a significant demand for this money. Currently, its uses have been pretty much restricted to multifamily. We are interested in expanding its uses and making, sort of coming up with creative ways that we could expand current programs or leverage current state programs around down payments. So I think we're looking at ways to kind of mitigate certain market forces, help meet the need in certain areas. And so, I think there's I think there's creative ways to make this money work for us, work for the population that we're trying to assist with homeownership or multifamily or what have you. So we can come back annually and give you a report. We're happy to do that. We could, probably have to update our strategic capital analysis. I mean, we probably should do it every 3 or 4 years. I'll defer to Hazim in terms of timing, but, I don't anticipate a major impact in the short term. But, we're kind of moving money, right, from making interest-bearing loans to more mission-driven kind of business. So over time, maybe long-term, it could have an impact. All of that will depend on a variety of variables, including interest rates and payoffs and refinancings and production and, volume cap. I mean, there's just so much we'll have to really model and see. But I think for the next 4 years, for the strategic plan, we have ambitious goals. We want to do a lot. You'll see the next hour or so. And so I think this really aligns with that.
Commissioner Perez, you have a question?
In general, I don't have a conceptual issue with what it's been said. It makes sense to me, except that going from on a permanent basis, that bothers me a little bit, right? That makes me uncomfortable a little bit, because once you do it permanently, there's nothing to trigger you to go back and look at it, and things could change. I mean, we're in a situation now where who knows, right? If that statement I'm about to make is going to be true, now the rates may start coming down, right? So the market may change down the road, right? That's not going to happen in 6 months or 9 months. I'm not saying it's going to happen in the next year. I feel more comfortable this being a major change, going from the 50 to 75. That at minimum, we definitely have a trigger that you're going to come back to us in a year and give us some sort of analysis, versus simply saying, yeah, we'll do it periodically and blah, 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 So either make it a requirement that is only for a year, or part of the approval is you're definitely going to come back a year from now with some sort of analysis, let us know how it's working out. Because the market could change. I mean, if rate starts going down and then we go back into, the market goes back into doing mortgages, single family mortgages, we may want to do something different,
Right.
And I'm not saying I have a crystal ball. And I understand we got to make decisions with today's facts. And that's why I don't have a problem in general voting for this, except for the permanency of it.
I personally like that suggestion because the thing we really voted on was the 50% and with the analysis and everything. And now we're doing a 75%. Maybe it should just be for 1 year and, and then revisit it a year from now if we want to do it again. Would that, maybe, I think I'm seeing some shaking heads. So, what do we think about maybe amending our resolution slightly for that?
I move with the amendment.
Okay, I think that's prudent. I'd like that. Okay, I don't see any more questions at the moment. So has any board member joined since our last roll call? Okay. May I have a motion to accept the revised resolution providing for the going to the 75% for only 1 year?
Moved.
Well, Phil already moved it, so I'll second it.
Okay. Any further discussion?
I'm offended George doesn't know my voice by now.
I apologize,
didn't move
Tim.
it, but yeah.
I definitely recognize it now. So I stand corrected. Tim moved it, and I'll second it.
Okay, any further discussion? All in favor, say aye.
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 We
Aye.
have any opposed votes? Any abstained votes? With that, the motion passes. On to our next item, allocation of state carry forward.
Thank you. So the last action item for finance pertains to the private activity bond volume cap. Last December, the State Bond Commission awarded CHFA $99,057,840 of unused 2023 private activity bond volume cap. To preserve the award, the Internal Revenue Code requires us to file a carry forward application by February 15. We are recommending the approval to carry forward 100% of the award for homeownership. In addition, on December 19th, the Census Bureau released the state's 2023 projected population numbers, which was lower than the prior year. The decrease impacted CHFA 2024 tax exempt volume cap allocation and the 9% low-income housing tax credit calculation, and the lending plan has been updated accordingly. I'll be happy to answer any question the committee may have regarding the resolution.
Hazim, can you give me a sense? Is the 99 million one of the highest we've ever had allocated to us, or?
No, there was 1 year, I think it was about 2 years ago, it was even higher than that. It was in excess of 100 million.
Okay. So this is standard stuff. Is there anything we're doing here that's unusual, or would we always kind of modify our plan based on our allocation?
We basically, so there's two things. The plan doesn't get finalized until we have all the numbers. So the census, they generally would release their numbers at the tail end of December. What we do, I would say, check on or revisit and analyze is whether or not we would carry forward the volume cap for multifamily or for homeownership. So last year we did it for multifamily, but this year we are moving it to homeownership. And the intent is to utilize our current year 2024 cap for multifamily.
Okay, this was a subject of a hearing at the legislature, talking about how different agencies use their private activity volume cap.
Right. Yes.
And we typically use it for single family, right?
Both.
Both. Okay.
So the goal is, it's more about how any agency would manage the volume cap, because the code allows for the agency that has cap, and then if they have the ability to carry it forward to the succeeding year, they have 3 years to utilize them before it just goes away and expires.
Okay. I don't see any questions, so I'm going to ask for a motion to approve.
Moved.
Move,
Tim.
Kathy.
Second, Tim.
Thank you. Any further discussion or questions on this? I'd like to call for a verbal vote. All those in favor, please say aye.
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 Do we have any opposed votes? Any abstentions? Hearing none, the motion passes.
Thank you.
On to our external auditor report.
Okay, so before I pass it over to Tom and Lindsay, just want to provide some color about the audit plan. So every January and after the close of CHFA's business cycle of 12/31, our auditor is required to present to Finance and Audit Committee and the board the audit plan for CHFA's audited financials. The idea is to ensure the auditor has a good understanding of our business, evaluate the risks, and apply the necessary protocols and respond to any feedback from board members. Based on the plan, the auditor believes that it will be able to complete its work and issue its opinion before the April board meeting. With that, I will welcome Tom along with Lindsay to go through the 2023 audit plan.
Yeah, thanks, Azim, and thanks everybody for having us. I think Azim just summarized everything that we need to talk about. So well done. We have a little bit longer document though that we'll go over. Is that attached in the agenda, or is that something we need to share?
We have it on the screen. So
Okay.
I have my assistant Lorraine that's managing the slide. So you just need to say which page that you want her to focus on.
Okay. So to add to how Azim just introduced us, again, thank you for having us. I'm Tom Goldfuss. I'm the partner at Whittlesey, and Lindsay Tesler, our manager, is on as well. So we're both going to go over the document to you and highlight a couple of key points. The main thing, again, making sure that we communicate to you our plan, responsibilities, your responsibilities, and then any dialogue questions you may have or areas of concern. But the first page in front of you here, the summary is we're tasked with creating an efficient audit that's designed to provide reasonable assurance that the financial statements of CHFA are fairly presented in all material respects with accounting standards. Our responsibility is to design procedures with the risk of fraud in mind. Our audit's not designed to necessarily detect fraud, but to make sure that there's reasonable assurance that there's no misstatement resulting from fraud. We also proactively identify issues to seek additional audit evidence for, and basically make sure that the footnotes and disclosures are transparent and follow accounting standards. Of management, we expect that we'll be responsible to ensure that CHFA complies with all laws and regulations, to provide us with all financial records and information to support those records, and to adjust the financial statements to correct any material misstatements which would occur during the year or after year end. Our experience working with you the first year was that it was pretty smooth, so we don't anticipate that there would be any of those. But the responsibility is of management to make sure that the financial statements are corrected and prepared and given to us to audit. From the audit committee and the finance committee, as well as the board, to communicate any significant matters to us that may have an impact on those financial statements, provide feedback to us on our scope of the audit. That would be what this meeting here is for. During the course of the year and then throughout the engagement, and right now, investigate any alleged or suspected fraud or wrongdoing by anyone within the organization, and to inform us of that as well. So I think that's an important step that I want to make sure that the committee is aware of, that we're your direct line to anything that is on your mind, anything you want us to look into. We are that avenue. As part of our work, we do reach out to various people within the organization, as well as possibly the board or audit committee, to ask direct questions, but as a form of negative assurance, if we don't, if no one reaches out to us, that we don't reach out to, that the assumption is that there is nothing to look at, because you should know to reach out to us if there is anything to look into further. The next page is a good follow-up to that last point I made about how you would reach us. The engagement team, again, myself and Lindsay are listed on here. You have our direct lines, our email addresses. My cell phone number is on here. So we are available to anybody in the organization, anybody on this call, at any point in time, whether it's during the audit process or anytime after the audit process. The engagement team is the same team that was on last year. So everyone is back. We have two managers on the team, Lindsay, as I mentioned, and Naomi. Naomi is primarily the manager on the single audit side of that. So that's for basically your compliance over your major programs, as well as the internal control work we do, which is the compliance audit in accordance with government auditing standards. Lindsay handles the financial statement audit and is very experienced with within our bank practice as well, financial institutions, as am I. Lisa Wills is the other partner on the engagement. She provides a second set of eyes at the end of the work just to make sure the quality control is good, review of the financial statements, and just another person to make sure all disclosures are proper in accordance with not only generally accepted accounting principles, but also GASB. We don't feel there's any relationships between Whittlesey, our staff, anybody within the company that would impair our independence, which we're required to maintain our independence throughout the engagement. The primary step there is make sure that nobody within the firm or any key covered members of the firm have any financial interest in CHFA. So we do verify that during the audit and throughout the year. As far as timing goes, we did start work with planning and interim risk assessments in December. Our year-end procedures are expected to take off February 26th. So the team will be working on the year-end numbers and reviewing at that point in time. Internally, we've already started to do our internal work as well. And as he mentioned, delivery will be prior to the April board meeting. So you'll get our draft audit report well in advance to make sure that everything is the way it should be. The next page is our responsibility under professional standards. The first of which is to provide you with an engagement letter that specifies the terms of our engagements and these responsibilities, a lot of which we're talking about today. We did a 3-year engagement letter as outlined in our proposal on August 5th, 2022. We also verify those terms and responsibilities to you in an annual letter. I don't believe it needs to be signed, but it is just our communication to you to confirm those, as well as confirming our independence to you as well. As I mentioned, the audits performed not only within generally accepted auditing standards, but also as a public, as a quasi-public entity with federal, with government funding. The government auditing standards also applies. So that revolves looking at internal controls and making sure that financial controls are properly designed and implemented, as well as those controls over your grants. So it's a little more thorough than just a regular audit. And a separate opinion or a separate report is issued, I should say, on that to make sure if any significant deficiencies or material weaknesses are identified, whether that be over financial statement reporting or over compliance with programs or laws and regulations, that we would report that to you. So that's part of our audit. Final point here is our audit of the statements do not relieve management of its responsibility for accurate financial reporting. Don't think I need to talk too much about that because, again, in our experience, the financial reporting and the financial controls are very good. And then with that, I'm going to hand over to Lindsay, and she could talk about some of the more technical aspects of the audit approach.
Right. Thanks, Tom. Good morning, everybody. The next section here is our planned scope of the audit. The first piece just talks about how material misstatements can result from errors, fraudulent financial reporting, misappropriation of assets, or violations of laws or governmental regulations. Typically, we would communicate any significant findings at the conclusion of the audit, but if anything big came up or anything, we would definitely be in touch before that. We take a top-down risk-based approach, so we perform a risk assessment in conjunction with our walkthroughs just to determine the risk of each area, and then we tend to focus our audit effort on the higher risk areas. If you could move to the next page. We use a materiality threshold. So we have 3 levels of materiality. The first one is our overall materiality level, which is based on total assets. We then haircut that down to our testing level. And then we also have a trivial level, which is used to communicate misstatements, which is typically about 5% of the overall level. We will use the work of others where we can, which typically is through internal audit. We'll perform some analytical review procedures. Those are typically over income statement accounts. And then we'll also do substantive testing, which is the bulk of our audit work. We'll send out confirmations, look at general ledger reconciliations, invoices, things like that. And those will mostly be based on the year-end account balances. Down below is just some fraud risks. I think Tom went through that pretty extensively. Also related party relationships and any significant and unusual transactions. As he mentioned, if you are aware of any, please let us know. We don't necessarily expect anybody to speak up right now, but our contact information is within this presentation. So you can please feel free to reach out to us. If you want to move to the next page, please. These are just our critical accounting and auditing areas. I won't read them line by line, but the first one here, the federal and state single audits, is a really big area of focus for us. We perform our major program determinations, and then we also test the significant internal controls over the requirements. We also test internal controls over financial reporting and also look out for management override of controls. We will test some journal entries. We also test investments. We confirm all the securities and also look at the fair value disclosures. We'll look at the valuation of the interest rate swaps. You use a third party, so we look at their report and make sure that the third party is independent and qualified. We'll look at loans receivable, specifically the calculation of the allowance for loan losses. We also look at outstanding debt, and we also send confirmations for those items. And then revenue and expenses is what I touched on earlier. We typically will do mostly analytical review procedures, and then if anything stands out, we'll test some individual transactions. Then the last page here is just some recent accounting pronouncements. There really haven't been a lot of changes year over year. Management does a really good job of going through them and doing their research and kind of coming up with their plan for each of these statements. So, we work very closely with them and just to determine which ones will and won't be applicable. So I think what we have. So if anybody has any questions for us, certainly let us know.
Questions for Tom? Lindsay? Okay, let's
I
move-
have one. I mean, that's curious, and please nobody misunderstand what I'm about to say. Do you guys look, I know you look at the assets, the expenses, understand what audits are. But what about potential relationships that any of our employees may have with any entities we do business with? Is there any time you spend on that? And I'm not saying there's a particular need. There's no specific reason I'm asking that question, except that I'm curious.
Yeah, we would typically look at, first of all, policies and see how those are monitored with something to that effect. We have in the past done a search of addresses of vendors and employees. That's certainly some of the testing that we can do. If it's an area, I would say if it's an area of concern for you, if you think that we should look at that, we would look at that. That's something we could do. It doesn't always result, it very rarely results in anything of a finding. So it might not be it's not the most effective test if you're looking for fraud or collusion. But it is something that we would look into if there's an area of concern there.
I want to emphasize, I don't have concern in that
I
area.
didn't
I was
think
just
you- I
curious
didn't
because
think
we've
you-
had that issue in the past,
Yeah. Yep. Yeah.
but today I
lot
don't
of
have any
times-
concerns.
A lot of times where that comes up is when we'll look at at times we'll look at vendors in terms of aggregate payments made to vendors and focus on that. If small vendors are, typically might not be something that we would follow that through a little bit thoroughly, but certainly your larger vendors, we would want to understand if there's any relationship there. So sometimes that test work comes about just through the next layer as we dig. But specifically test designed for that, we don't always do that. But again, it would be something that if it was an area of concern, we would do.
Do
Thank you.
CHFA
And again, I want to
employees,
emphasize, I'm not aware of any issues.
Yes. Yeah.
do CHFA employees complete the financial disclosure requirements that a lot of state employees need to? In fact-
Madam Chair, the ones that are required to do, and
Yep.
I look at that list, look at what everybody's job is, and then
Yep.
file what we need to with the Office of State Ethics. So yes, the answer is yes. Those who
Okay.
are involved in contracts and vendors
Not everyone. I
do
know.
that, correct? Yes.
I have another question. I mean, this is something we do at the Department of Banking. We, on the annual basis, I send out a memo about our ethics rules and so forth. And we require all our employees to tell us if they have a loan or any relationship with any entity we do business with. Then obviously, if you're an examiner, we don't have you examine the bank or the credit union or the mortgage company or whatever entity, the financial, the brokerage. Do we do something similar to that in CHFA? Do we have employees tell us, do you have? I mean, that's one way.
Commissioner, yes, we do that as well.
Okay.
There's a
Great.
form that
Terrific.
we fill out
Terrific.
for current employees and new employees coming in, if they have connections, any type of connection or
And do you
loan or,
update that? Do you update that on some sort of periodic
yes,
timeline?
yes, every year.
Terrific.
Yes.
Terrific. It makes sense. I'm not
And
surprised.
again, we'll make sure that we look at what Terry just mentioned, look at that for the current year, and verify that the policies are being followed and the disclosures are being made as required.
Being no questions, let's move on to financial reports. Allison Murphy.
Good morning. Before you are the December financial reports, I do want to point out that these numbers are preliminary, as we do expect to be making a few additional adjustments as we close out the books for the year. On the revenue side, mortgage loan and investment interest revenue are coming in 23.1 million above budget for the year and 47.9 million higher than prior year. The revenue variances continue to be primarily driven by the increase in interest rates on the authority's short-term investments. On the expense side, bond interest expense is 1.1 million below budget for the year and 26.8 million higher than last year. We continue to see the same drivers behind the year-over-year variance. Outstanding bonds are higher than the same time last year by $226 million, and interest rates on the authority's variable rate bonds have also increased. Servicer fees are 7.3 million above budget for the year and 8.7 million higher than last year. The large increase in our single-family production is driving these variances. Administrative expenses are coming in 6.2 million below budget for the current year and 2.6 million higher than last year. When you exclude salaries and benefits of 29.4 million, the current year expenses are 240,000 higher than last year. And lastly, the change in net position is above target by 27.7 million. Are there any questions?
Being no questions, we'll move on to production and delinquency report. John Chilson.
Good morning. For the month of December, the authority purchased 271 single-family loans totaling $68.5 million, of which 250 loans totaling $63.2 million were securitized, or 92% of December's volume. Remaining 21 loans totaling $5.3 million were whole loans. The average loan size was $253,000. End of December, the mortgage-backed portfolio security balance ended the month at $2.6 billion, which was $48.5 million more than November.
No, I don't think you are. I have a call with Wendy at 1:30, so I'll bring this up.
Can we mute Jay-Z? Thank you.
The whole loan portfolio through November declined by 41 loans, or $4.3 million, ending with a total portfolio balance of $1.1 billion. The overall single-family delinquency rate decreased by 6 basis points to 1.34%. And the year-over-year loans in foreclosure declined by $10 million to $11.8 million, and the number of loans that declined year-over-year by 88. For December, the authority also funded 340 down payment assistance loans totaling $5.7 million. The average loan size is $16,900, and also 252 time to own forgivable loans totaling $7.9 million. And the average loan size for the time to own was $31,300. There were 6 new loan closings in our multifamily portfolio in December, bringing the total count up to 580 loans totaling $1.3 billion. There were 9 loans with a delinquency status, and the overall delinquency rate for our multifamily portfolio was less than 0.5%. Any questions?
Thank you, John. You know, there's a lot of numbers in this report, but I sometimes don't get a sense. Are we up? Are we down? You know, can you give a general assessment? Is production up? Is it down?
Yes, production has been steadily declining throughout this, increasing throughout this year. Actually, it's been a very, very good year production-wise, significantly ahead of 2021, 2022. And the delinquency rate is probably the lowest it's been probably since the financial crisis. And honestly, I'm not sure how long we'll hold it there right now, but overall, even our whole loan portfolio on its own is around 4%, which is very low for a portfolio of first-time home buyers.
Any questions for John? Okay, we're going on to our investment and swap report. We get periodic reports on this, and I think we have a new presenter. Could you introduce our new presenter?
Yes, my name is Mingyan Li. I'm the Capital Market Operations Manager in the Finance Department. I will be presenting the investment and swap report today. In the fourth quarter of 2023, the authority's investment portfolio had an increase in book value by 167 million to 3.8 billion. Program assets also grew by 193 million to 2.6 billion. The weighted average yield to maturity was 4.06%, up from 3.93% in the prior quarter. On the swap side, the swap notional total was 924.8 million, a decrease of 11 million from the prior quarter due to swap amortization. There are 42 swaps with 8 counterparties, same as prior quarter. The weighted average pay rate by the authority decreased from 2.992% in the third quarter to 2.961% in the fourth quarter. Mark-to-market value decreased from about 69 million to 25 million. This concludes my report. I'll be happy to answer any questions.
Questions? Yeah, let's move on to our internal audit report. Joyce Kielke.
Good morning. Before you is the internal audit report. I'd like to start off by providing you with a summary of the loan activity that internal audit performed in the second half of 2023. Starting with a review of the authority's business functions. Our focus was on the front end of the home ownership business. So in accordance with the plan, we completed an audit of the home buyer mortgage loan origination audit. The audit reviewed internal controls over homeownership's review of mortgage loan applications underwritten by lenders through the issuance of loan commitments. Loan files are generally reviewed for compliance with loan program underwriting guidelines, depending on the program, which there are numerous programs that are offered, and tax-exempt bond requirements. The scope of our review included loans committed for an 18-month period, and we reviewed key homebuyer mortgage loan programs, including conventional, government insured, which is the first mortgage programs, as well as the down payment assistance and time to own subordinate loan programs. Management is implementing the audit recommendations to enhance controls over the process. For example, updating the authority's procedures and operating manual. All of the recommendations made are included in the attached audit report. Turning now to servicer compliance reviews. Servicer compliance reviews, we perform limited scope reviews of the loan servicing and collection functions performed by our single-family loan servicers. The reviews were completed in the first half of 2023 and represented 19% of the whole loan portfolio. And lastly, in terms of consulting and advisory services, finance has been implementing a new system. And so during the period, we reviewed the reconciliations performed between the old and the new systems for the single-family portfolio management systems, as well as the accounting system. We verify that account balances reconciled before the go live date or conversion to the timeline. The next two pages in the report include the detail of all the audits, servicer reviews, and planned consulting activities performed in full year 2023. Lorraine, can you advance the next two slides? Thank you. Turning now to 2024, I wanted to provide you with a proposed audit plan for 2024. Annually, we review top risks likely to affect the organization based on audit guidance. We discuss key business priorities, risks, and changes with various members of management throughout the organization. And we update our risk assessments. From there, we developed a draft audit plan, and we may defer certain areas which may be undergoing business or technology changes. So in terms of background, our audit portfolio divides the authority into business functions which typically follow the transaction flow. Those segments are risk rated. The servicer portfolio represents the single family loan servicers which process the authority's homeowner mortgage loans. So the audit plan then becomes a subset of audits from the audit portfolio, a cyclical compliance review of select servicers from the servicer portfolio, as well as planned consulting activities at the request of management. We review the plan with management for the draft plan. We also are checking to see that our audit coverage aligns with the authority's goals and objectives. So throughout the year, we continue to assess and we modify the plan based on things like business priorities and requests. So continuing our audit coverage from 2023, which was focused on the front end of the homeownership business. In 2024, we are proposing to move forward to the back end of the homeownership business function. So we've identified 4 areas that are the functions of which are performed by finance portfolio management. This would be on the single family side. So the audit coverage would include reviewing internal controls over the purchase of mortgage loans, the pooling of mortgage loans and the purchase of investments, the processing of loan payments, and the monitoring of loans in the delinquent and foreclosure status. Now, as I mentioned, we are moving to new systems. So as applicable, we will be reviewing doing a deep dive with those new systems to look at the system controls as it relates to those 4 segments. In terms of the multifamily business, we plan to review controls over the development cost certification process, as well as perform follow-up reviews on the HTCC program. Switching gears to servicer compliance reviews. So again, we perform limited scope reviews of our single family loan servicers. We typically look at the processing and the collection functions with a focus on compliance with key contract terms and insurer guidelines, state and federal regulations. We typically do around a 3-year rotation, but may defer a segment if they are undergoing, if there's some sort of change. That would be discussed with management. So for 2024, we have identified 3 loan servicers, which represent 43% of the homeowner first mortgage loan portfolio. And in terms of consulting activities, to assist management with improving operations and accomplishing business objectives, we do from time to time perform advisory services. The audit plan includes those which have been requested or known at this time, and they include, for the first would be bill for CT. So we've been asked to look at the process, the controls, the documentation that the authority has put in place to administer the program. Other items include reviewing the mortgage loan operating manuals and any relevant sections of the authority's procedures as they are modified and revised. We will continue to monitor implementation of IT security controls, which have been incorporated into a 5-year plan to further mitigate cybersecurity risks and enhance controls. And then lastly, we are participating in, as members of a few authority-wide committees, including the Technology Governance Committee. Any new planned activities will be brought forward and disclosed throughout the plan period. And with that, I'd be happy to answer any questions that you may have on the plan or any other activities.
Joyce, we have limited time today, but at a future meeting, I might like to hear a little better, understand how you coordinate with the external auditors. We have external auditors and internal auditors and how you coordinate your plans together. I don't think we have time today, but I do feel like between both groups, we're in what good hands. Does anyone have any questions for Joyce? Okay, let's move to our final action item, which is approval of the minutes of the Finance and Audit Committee meetings of November 30th, 2023. May I have a motion? Second? Kathy?
Second.
Thank you, Kathy. Okay, so all in favor say aye.
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 Do we have any opposed? Do we have any abstentions? Hearing none, the motion passes. Thank you, everyone. We'll adjourn the meeting. All in favor, say aye. Thank you.
Aye.
Aye.
Thank you.
Thank you.